Hello, I'm Ernie Humphrey, the CEO of Treasury Careers. I would like to thank everyone for taking the time to join us for our webinar today, Cash Application, Turning a Nightmare into a Dream. I would like to thank our webinar partner, HighRadius, whose strong commitment to thought leadership helps us make this webinar possible today. Cash application continues to be a thorn in the side of even the most seasoned Treasury professionals. Inefficient cap application inhibits working capital optimization, damages customer relationships, and impacts the productivity of employees involved in the cash application process. Many companies accept cash application headaches due to beliefs in common myths which prohibit them from discovering best practices and cost-effective technology that can offer relief from even the worst cash application headaches. Today, our featured speaker, Raj Jamal, Senior Solution Principal HighRadius, will dispel 7 common myths of cash application. You will discover how, irrespective of the maturity of your current cash applicating processes, your company can mitigate the manual keying of information, capture of email and web remittance, achieve real straight-through processing, and free up resources for high-value work. Before I delve into the content, I'm going to offer a few quick words about Treasury Careers, cover a few housekeeping items, and then review our learning objectives as they serve as the pillars of our value proposition to you for spending your valuable time with us today. Treasury Careers offers content and resources that empower Treasury professionals to own their career success. I encourage you to visit our website at www.treasurycareers.com. Now for the exciting housekeeping items. For those of you who are interested in CTP credit for today's webinar, you're going to have to answer all the polling questions and remain on for the duration of the webinar. If you have any questions regarding CTP credit, please send me an email to ernie@360thoughtleadership.com. We'd love to hear from you today, so we encourage you to ask questions in the questions area of your GoToWebinar control panel at any time during the webinar. We'll do our best to get to your questions during the Q&A session at the tail end of the webinar. I encourage you to take advantage of the opportunity to tap the great expertise of our featured speaker today. Finally, we appreciate your consideration in taking a short survey at the end of the webinar today, as we always strive to improve the ROI we offer our event attendees for their valuable time. Now our learning objectives, the pillars of our value proposition. We'd like you to understand common inherent barriers to effective cash application, to be able to separate 7 common cash application myths from reality that may be inhibiting investment in cost-effective technology and the adoption of cash application best practices at your company. We'd like you to be able to identify opportunities to leverage technology to deliver more efficient cash application to improve working capital management, customer relationships, and employee productivity. One more objective that I have for all of my webinar attendees is to take an action. I'd love for you to take an action either during the webinar or after the webinar. Today, during the webinar, ask us the question. After the webinar, in the post-webinar survey, request to be connected with a speaker, have a conversation with a colleague about cash application, view some additional resources on the HighRadius website. We're not going to be able to fix all of your cash application issues today, but we're going to be able to arm you with the information to ask the right questions and set your path forward to best-in-class cash application. So now I'm going to welcome Raj Samal, as he will be doing most of the heavy lifting and delivering on our learning objectives here today. Raj is a Senior Solutions Principal at HighRadius. Raj has over 9 years of experience helping companies develop and implement credit and accounts receivable process improvement programs. He has worked with Fortune 1000 companies and SMBs, including Blackhawk Network Holdings, Avanti, Edward Down & Company, and Dixie. Raj, welcome to the webinar.
Thank you very much. It's a pleasure to be here.
All right, now let's get to how are we going to accomplish our learning objectives here today? What's our roadmap? First, we're going to talk about why is cash application a nightmare. In this, I'm going to share my personal experience a little bit. I was a treasury manager for a long time, and this was actually a nightmare for me. My specific horror story was that for one of our biggest customers, when we received a wire, it took us 3 or 4 days in order to apply all the cash. So that's my personal story here, and you'll see I'm very excited about this topic because I'm glad to see the technology has finally caught up with some of the challenges that we face, and there's really some tremendous value that can be realized from effective cash application. So we'll talk about that nightmare, really put a fine point on it, a rude awakening, and then we'll welcome Raj back to the webinar. He'll tell us a little bit about where he works, High Radius, and he'll get into the 7 myths of cash application, and then a very tremendously valuable resource, the cheat sheet for cash application. So throughout the webinar, I always point out where I think people should actually print out slides, and this cheat sheet is fantastic, and I wish I would have had it when I was a treasury practitioner. So why is cash application normally a nightmare? So we'll look at it in 2 areas. First, in terms of checks in that lockbox, we have oftentimes data is keyed in, inaccurate, incomplete, non-configurable. We can have issues with our lockbox instructions. I was just telling the story the other day about my situation with lockbox instructions. So what we'll see here is what we see. We have checks coming in, remittance check stubs, and then what happens is that lockbox file, here we go. We get it, we need to reconfigure it, there's errors, we might need to scan remittance images, we need to key in missing remittance data, run file through ERP, involve our IT team, take up some of their resources, code deductions, and post cash in the ERP. So you'll notice your head down, there's often a lot of manual processes, a lot of file fixing going on. So in order, and there's a lot of reasons why there's some errors here, and we'll talk about why, but a lot of it is due to the manual intervention that's taking place throughout the process, and there's often many parties involved. Often it might not be the same person who's doing all this work, so there's some workflow issues. So that's one case, and that was common for me. Like I said, when that large wire came in from our customer, I always wanted to go and buy that woman flowers on our cash application team because I knew it was going to be a rough couple days for her. And then we'll focus on electronic payments because I think we're starting to see that companies are getting more electronic payments. And this is really the normal case, and you'll be happy to see that it doesn't really need to be a nightmare with electronic payments, but some of the issues that we have, you can get an email with body attachments. You can have to go to websites, EDI files, customer portals, or get remittance. If you're lucky enough to get that remittance detail, it's received from multiple sources. You often need to decouple payment and remittance information. So here we are again, we're slouching over in our chair. We got to collect it. We got to read the remittance information. We have to link it with the payment, match payment with open AR invoice. This is a part where I usually had a lot of bottleneck. And then code deductions, what if you're short paid, create file, and post cash in the ERP. So you can see all of this manual intervention here. And again, I think we're starting to see that more companies are, electronic payments are more common. But the good news is that there are ways to really make this a much easier process. So from my perspective, the cash application nightmare, it became even harder for me to sleep. Some of you who have probably just gotten through this, you're still having this. We have year end. So those of you in Cash App, when year end, you got everybody, the controller all over you. You just want to put your pillow over your head. And then I just wanted to note that we're coming up on quarter end here really quickly. So you might be starting to get this look where you have your face under the covers. So hopefully we can inspire you to look at investing in technology that allow you to implement best practices, and then you'll have no more nights with that pillow over your head, and then you'll be able to get more sleep. I'm going to go ahead and launch our first polling question here to get a sense of where our audience is in terms of electronic payments that they are receiving. So asking you to share with us if you're starting to receive more electronic payments. If we want to put a time frame on that, let's say over the last 12 to 18 months. So we have yes, no, their customer prefer checks, no, you prefer checks, no, a small team your team's too small, you don't really have e-payments, or we have no technology to process e-payments, I want to remind those of you interested in CTP credits that you'll need to answer all of our polling questions here today. We appreciate everyone's consideration in answering all of the polling questions. And also, we can take your questions at any time during the webinar, so please do that in the questions area of your GoToWebinar control panel. I'm going to go ahead and close our polling question here. Then we're going to go ahead and take a quick peek at the results, and then we're going to get back to our content, a little bit a rude awakening, and then we'll move on to talk about the 7 myths of cash application after we welcome Raj back to the webinar. So let's see, close the results here real quick, share those results. And I think the results are just a little bit surprising to me. I'm a little bit surprised to see that number is 86%, is that high. So it's good to see. So that means we need to pay even more attention to the electronic payment side and all the complications on that side. Raj, do you have any thoughts? Is that about what you thought we'd see, or maybe higher or lower?
So yes, I had done a little bit of white paper studying myself, and I thought the numbers would be much higher, close to north of 90s.
Okay. Okay. All right, thank you very much. And thank you everyone for your consideration in answering polling question. So let's get back to our content. So this rude awakening, look at some benchmarking here. What percentages of receivables are processed straight through? 56% of the folks surveyed in the AFP electronic payment survey, none. 10 to 20%, 10%. And then where I'd like to see us be, and those of you that invest in leveraging in this technology that we're going to discuss, 8% more than 88%. So 66% of teams process more than 80% of receivables manually, and we know that's painful, so we know we're losing a lot of sleep out there. So what we'll do as we talk about how these myths are dispelled, how the folks that have gotten past these myths, and really what we'll see is part of how they've been able to get over these myths and make them and leverage that technology, is that they're able to process those items in straight through processing. So what we're going to do now is we're going to shift over to the 7 myths. So I'm going to go ahead and hand the floor over to Raj Samal, my esteemed co-speaker here for the webinar today. So Raj, let me go ahead and hand the floor over to you, and I can see your screen, my friend. Take it away.
Thank you, Ernie. I'll speak a little bit about HighRadius and what we do. So HighRadius was founded in 2006. We are a fintech company headquartered in Houston, and we are the only provider of AI-enabled integrated receivables platform for the entire credit-to-cash cycle. We are the #1 receivable player in the Fortune 1000 market with over 300 customers, 40% of which we have acquired the last year. Our integrated receivables platform processes more than 500 billion worth of receivables annually, and we have more than 650 employees across the globe. On the bottom right section, you can see some of our Fortune 1000 companies using our integrated receivables platform. The common ones are Walmart, Starbucks, and Adidas. So moving on, as Ernie rightly explained, there are 7 common cash application myths which differentiates the top AR teams with more than 80% straight through processing from the others. So let us take a look at what these myths are. Here are the different myths. The first one being Lockbox services are necessary for check payments. Second being electronic payments like EFTs are easy to process. Third is it is impossible to automate cash application with non-standard remittance. The fourth being we don't need cash application. We already process straight through. Fifth is we already have a great solution in place. And sixth is it's better to invest in AR operations which are more strategic rather than manual cash application process. And last but not the least, cash application automation needs expensive on-premise systems. So let's go through each of them one by one. And here is the first myth. So it is a popular belief among AR managers and treasury that bank lockbox service is mandatory to automate cash application payment. When you depend on your bank to manually capture the check information, here are the few questions you need to ask. Is the information accurate? Is the information complete in the sense that are all the necessary piece of information present? And does the bank have your open AR, like your open invoice numbers, open amount, PO numbers, and sales order number and tolerance limit in place to match what they are keying in against? Is the data stored in a proper file format? That means, does the bank provide you the information in a format which can directly apply in your ERP, or your team has to manually do the exception handling and data massaging in place? So what your typical salesperson will tell you is that we will do all the heavy lifting for you and you just have to sit back and apply the cash. And after all, it is logical, right? If you're paying the bank so much, they're supposed to do all the heavy lifting. But the reality is the bank goes off easy, giving you a lockbox file with all the check information in a format you do not want or your IT cannot configure without the data that you really need. And your team is left doing all the work for applying the payment, coding the deduction, and handling the exception. So, moreover, the bank could end up charging roughly $1 to $3 for a single check. Imagine companies receiving 10 of thousands of checks a month, and you could be easily looking at a 6-digit banking in fee for the whole year. To further add on, bank keying in cost is not all. There is an additional work involved that translates to additional man hours spent by your team in different activities, which further adds up to this cost. And the result is a direct leakage from the bottom line. So at this point, you need to retrospect if using the bank lockbox service is cost effective, and more importantly, do you really need it? Moving on, how would you ideally want to automate check payments? Well, there are two different options here. You could use the cash application automation tool where you retain your lockbox, but you entirely eliminate the need for banking in, thus reducing the data capture cost. Or you could do away with lockbox altogether and opt for a remote desktop capture machine, which we call as an RDC machine. Either way, you would save significant cost and minimize the manual intervention. So I'll talk about each of these points one by one. To start with, let me explore how to process check with the cash application automation. So with an OCR, which is an optical character recognition enabled email parsing engine, the automation can extract data from scanned checks and remittance images sent by the bank. The remittance data is captured and it is used to close the open invoice and apply cash. Plus, there is an artificial intelligence on top of it, which learns your pattern and over a period of time applies cash more accurately and more effectively. The AR team could save as much as $1.26 per check payment, making a significant impact on the bottom line. So this is the first aspect. Let us cover the RDC in play. So with remote desktop capture or RDC, the check needs to be just collated and scanned once in the system, and going forward, the system will auto-create and send an ICL file to the bank for payments, while the remittance data captured is to close the invoice and post the cash. So with RDC, your team would not even need to look at bank lockbox service and ensure potential saving. So here's the first myth that is busted. The truth is, Specific to bank lockbox service, you do not need it in the first place. And to process check payment, you could use the automation to reduce the data capture cost or leverage RDC to completely eliminate lockbox fee. Here comes the second myth. So the second myth explores the electronic payment and how they are considered really easy to process. Uh, Within the last 5 to 10 years, electronic payments are gaining popularity. And there's an increase in electronic payment, which is ACH and wire transfer, while check payments are gradually on the decline. The reason many companies are moving towards an electronic payment is the expected improvement in working capital that can be provided by e-payments. And company also expect that e-payment would decrease their transaction cost. And all of these expectations from electronic payments are thought to impact your DSO and reduce the overall operational expenses. However, in reality, as most of you would have observed, electronic payments have their own set of roadblocks. To begin with, the payment and remittance are separate, and sometimes the remittance comes in a different format. There are multiple sources of remittance, mainly emails, EDIs, and what I've seen over the past 4 to 5 years is large customers have actually stopped sending remittance altogether, and they host it in their own websites or web portal. And manual intervention is a necessity for processing these remittance. Here is a snapshot of how electronic payments are processed today. The bank sends the payment file while your team's analyst needs to manually collect the remittance from different sources like emails, websites, and the remittance gathered is manually linked with the corresponding payment. And the analyst then switches to a matching payment and opens the invoice, which is followed by a deduction coding. After this, they manually post the cash in the ERP system. So to further highlight the typical challenge in the current process, first of all, the remittance can be sent through any source. It could be an email body, email attachment, web portals, EDIs, and customer portal. And the cash application specialist needs to manually gather the remittance from all the sources and collate the required information in the system. Second point, with electronic payment, the remittance comes in separately. So it is essentially decoupled from the bank payment file. And once you have collated the remittance information, you need to manually link it with the corresponding payment. And adding on, as you can see, manual intervention is required at every step of e-payment processing. So this not only negates the dollar saving with the e-payment, and this also adds on to additional man hour being spent. And what it further does is it prevents any improvement in working capital or DSO, what you initially thought of. However, having an automated solution in place, your e-payment processing can be considerably simplified. The system can automatically capture the remittance from different sources and pull in all the necessary information from a single point to get all of these information at a centralized location. The linking engine takes the aggregated remittance and links it to the corresponding payment. Further, these payments are matched to an open invoice. So these short payments and reason codes are also identified and stored in the system. And the system that generates an enriched file after this will enable auto posting of cash in your ERP. This not only minimizes the need for manual intervention, this also resolves the roadblocks in processing the e-payment. So to summarize, electronic payments are not easy to process due to decoupled payments and remittance, but there is a lot of different sources of remittances here as well. However, your cash application team can overcome these pitfalls by using automation in place. Let me go to the third myth. This categorizes the problem of having too many remittance sources and formats and how this further complicates the cash application automation in place. So with the rise in electronic payment, the remittance data is no longer sent with the payment file, which was easy with a check. You always could send a check stub along with the check. Right now, the information is sent separately and it is sent directly to the customer using different methods, and it is received in a lot of different format. So what was previously a seamless process of automation for the customer has now become a manual task of getting all of this information and collating it. And email, Lockbox, and EDI are the most common source of remittance information. So how do you capture the remittance correctly? Based on my experience, since most of the traditional systems are rule-based, your AR team needs to frequently revise these rules to ensure that they resonate well with your remittance formats and templates. And despite the fact that email is the most common remittance source, the analyst needs to manually get the remittance from the email body or the email attachment, or sometimes from an unstructured email. Automated processing is limited to file format, that stores the information in a predefined structure, which, to be honest, would change every 3 or 6 months. And logging into a website with your credential, going to the right navigation, and downloading all the remittance information, it is quite an headache for the analyst. And to add to all of these, EDI rules needs mapping and configuration, and it requires maintenance to capture the additional fields like discount and reason code mapping. And this is something that typically needs an IT's efforts or an IT's intervention. However, with the disruptive technology such as AI, which is artificial intelligence, and RPA, which is robotic process automation, the remittance puzzle can be easily solved and automated. So let me briefly define what AI and RPA really is, and let me provide a very brief snapshot of both of these. AI refers to the ability of computer system to learn, reason, think, and perform tasks requiring complex decision making. And RPA, on the other hand, refers to the software robots who simply mimic the human action on a computer to complete the human process. RPA is typically rule-based and it is used for repetitive and manual tasks in large volume. AI and RPA serve as great technology combined to automate the remittance capture. So how it works together is AI-enabled pattern recognition, and AI enables this pattern recognition without the need for maintaining any template, while RPA does the actual heavy lifting of capturing this information. So with smarter solutions, remittance capture can be a cakewalk. With self-learning AI-based algorithm, there is no need to maintain a template or a rule. The system would be self-sufficient to capture the information from email bodies and attachment or from unstructured email format. The auto capture of data, irrespective of the format, would reduce the manual intervention. Moreover, web aggregation engine, these could act like mini bots, and it can log into customer portal and capture the remittance from supplier website. An AI-based EDI parser could capture the ever-changing EDI-based remittance. So to conclude, with evolving technological options, automating remittance capture across all format and sources is no longer impossible. Standard templates and rule-based processing are a thing of the past, and you should be more looking towards automation, which is shaping the future. And a self-learning automation enabled with RPA and AI can recognize pattern and capture all the necessary information. And companies have achieved an upward of 90% automation for processing remittance and payment file using AI and robotics. So in spite of different types of remittance sources and formats, AI and RPA enabled automation can be used to aggregate the remittance data from checks, emails, and customer portals and EDI files. So here do we have the poll question.
All right, thank you very much, Raj, for all your great insights. Gone ahead and launched our next polling question, asking you to share with us which of the following is the largest barrier for straight-through processing at your company. Multiple remittance formats, no remittance received, multiple ERPs, partial or truncated data. We appreciate everyone's consideration in answering all of our polling questions. Those of you who are interested in receiving CTP credits for today's webinar, you will have to answer all of our polling questions. Want to remind you that we can still take your questions in the questions area of your GoToWebinar control panel. Going to go ahead and leave that polling question up for just a few more seconds, take a quick peek, and then we're going to get to our myth number 4 that companies think they already process straight through. So let me go ahead and close that polling question and go ahead and share those results. It looks like we've got 41% the biggest challenges is multiple remittance formats, 31% no remittance received, 12% multiple ERPs, and 15% partial or truncated data. Raj, any surprises in there for you?
I would say this is something that I was kind of expecting.
Okay. All right, and then the good news is that we are going over all of these and how to take care of all these issues that folks have. So let me go ahead. Let's get back to the great content, and let's get back to getting after myth number 4.
All right. So moving on. This is myth number 4. So a lot of companies and AR teams believe that they already achieve straight-through processing or an STP. And they say that, hey, we already have straight-through processing. Why do we need a new solution in place, or why do we need automation in place? So I'll talk about the flaws here. A popular measure used to determine effectiveness of automation is hit rate. So most companies calculate hit rate based on the payment applied automatically as a percentage of the total payment received. And this is usually called header level hit rate, where the payment is matched with the customer account and posted on an account level. And this calculation can be pretty misleading as it does not factor applying cash at an invoice level. For an invoice level hit rate or an ILHR, the corresponding invoice of the customer are also considered, and cash posting is done at an invoice or an item level. So if you post at an account level, your team will still need to identify the corresponding invoices manually. And as a result, you cannot consider it as a zero-touch straight-through processing. The question is, how does your team calculate hit rate? So ILHR gives a better picture of straight-through processing, while if your team monitors only header-level hit rate, you do not have proper visibility into straight-through processing. So in order to get a more realistic picture of AutoCash effectiveness, companies must consider calculating hit rate based on line item applied automatically. And an ideal cash application solution should provide the breakdown of cash posting as represented in this figure. Here, the payment posted on invoice refers to ILHR, while the payment applied gives an idea of HLHR. So going forward, header level hit rate does not provide an accurate measure of straight-through processing. An inaccurate evaluation of metrics gives a false sense of, it gives you a false sense of performance. Therefore, AR team should be reconsidering on how they evaluate straight-through processing, and they should invest in reporting and analytics, which gives them better insights. Moving on to myth number 5. A lot of team members from AR, they typically overestimate their solution and they believe this is the best solution in place. and they fail to see any room for improvement or any scope of having a better solution. Now, let me take a step back here. So what ideally would you consider as a perfect cash application solution? And based on my interaction with different prospects and customers, the following enlists a key consideration for an ideal cash application solution. It should have a same-day cash application. There should be positive impact on all the downstream AR processes, and the solution should be scalable. So let me talk briefly about all of these factors here. Same-day cash application. So this essentially evaluates if your team can apply the cash on correct invoice on the same day when the payment was made. A few questions that you must consider here are: does your team need to stretch to cope up with large volume of line items, or they are comfortable with it? Do they struggle with account coverage? And is your team able to handle the seasonal spikes in payment, for example, during holidays? And if your team, or if your cash application team, can comfortably deal with account coverage, seasonal spikes, and implement same-day cash application, congratulations. You have got a great team in place and a great cash application solution. But if that is not the case, well, you do not have the best cash application solution. Let me talk about the second aspect. So cash application leaves a significant impact on the other downstream processes like collections. The ability to positively impact these downstream processes also indicates the effectiveness of your cash application solution. To give you a few examples, in the collection process, the cash application should apply the cash accurately, and it should ensure that the data is consistent and available real time to your collections team. So this eliminates any discrepancy and ensures better customer experience, as the collection process includes multiple touch points with the customer. Obviously, no one present here would like their collections team to call up on a customer for an invoice he or she paid yesterday, and this was not reflected in your system. And deduction analysts often waste a lot of time in categorizing the dispute line item. An ideal cash application solution should not only transform these reason codes and improve the deduction metrics like dispute resolution time and DDO. Similarly, the cash application solution should be involved in discount handling, where discounts could be auto-coded and unearned discounts can be auto-identified. And if your solution is not able to make a positive impact and improve the downstream process, your solution definitely has a lot of room for improvement. Let's talk about the third factor here, which is scalability. This is one of the most important factors for a cash application solution. And with the aggressive and dynamic change in the industry, the ability to evolve and adopt to these changes is a must-have for any AR solution. Some of the current trends, and I've taken this straight from CRF report here, includes there is an increasing acceptance of mobile payment. So more than 30% of the companies accept mobile payment today. There is a changing priority in the CXO level executives towards real-time payment. So 44% of them consider it as one of their top priority. And the growing adoption of ACH as a form of payment that includes more than 96% of the organization. And if your team does not have the ability to scale up with these dynamic trend in cash application, you certainly do not have the best possible team or the best possible solution today. So to summarize, cash application should be evaluated. The solution for cash application should be evaluated for different factors like same-day cash application, how tough or how much your AR team and resources are stretched, the impact on the downstream process, and scalability before tagging it as the best cash application solution. Now let's check the sixth myth. And here is where a lot of AR managers and treasury experts believe that since cash application is a low value process, investing in other strategic AR operation like collections or credit management would be more fruitful. And this is typical because the executives and managers, they expect greater focus and manual intervention for high value strategic operation like credit decision, which is the first one, followed by collections, invoicing, and cash application. And rightfully so. You obviously don't want a high risk customer, or you can't tolerate a high DSO higher than your average industry average. However, the reality is very different, and it is exactly the opposite of what your expectations are. Mainly due to an increasing volume of payment, potential manual efforts are invested in low value cash application and invoicing, followed by collections and credit decisions. This not only dilutes the focus and manual effort required for strategic AR function, but this also has a negative impact on the overall finance of the company. Therefore, I think it's self-explanatory that cash application is the low-hanging fruit and the best candidate for automation. So the typical advantages of cash application includes, first, it's a quick ROI. There's a quick ROI from cash application, and it's a low-hanging fruit. The resource reallocation. So this makes sure that your team spends time in strategic activities rather than manual tasks. And flatlining of AR teams growth. So a lot of companies have an increased growth rate or have an aggressive growth rate in terms of revenue. And the solution of throwing a body to it to tackle the AR team's dilemma is never an elegant option. Moreover, automating cash could end up in improving your cash flow, providing efficiency, time saving, having an enhanced customer experience, and it could ensure a more accurate reporting and visibility into your AR. So in essence, automating cash application is equivalent to dollar saving, as quick ROI gain can be achieved here. And with automation, bank lockbox fees can be eliminated. Moreover, as you can see from this graph, again, this is a CRF benchmarking report. The manual cash application cost per check is roughly $7, while automating it is like $1, $1.50. So the cost per 1,000 check itself is close to $70,000 for the manual process, compared to $14,700 for an automated process. That's a straight away $56,000 of saving. And needless to say, the cash application reduces cost and improves the KPIs. With automated cash application, your team can optimize the resource allocation and shift your team members to more strategic processes like collections or reducing DSOs. And as per survey from DollarSense, an automation with close to 90% hit rate eliminates close to 90% of labor requirement. And moreover, dealing with an increased volume of payment would be seamless and hence eliminating the need for increasing headcount in your AR team. So in a nutshell, automating cash application is equal to, or it's an equivalent part of killing two birds with a single stone. The first one is improving cash application and minimizing manpower requirement. And the second, at the same time, making a positive impact on other strategic processes. And finally, to summarize, cash application is a low-hanging fruit which has immediate hard cost saving, improved ROI, and resource optimization for other strategic process. Let's go to last but not the least myth, and this is my personal favorite. It's a popular belief that automating cash application would require an expensive on-premise system with an extensive IT support. And I would say how this came into picture. So typically an on-premise IT-based solution are the first preference for the AR team who consider automation. And sooner or later, they realize that the pain points and efficiency leaves their AR worse than before. And with on-premise solution, you have a capex expenditure, which includes a one-time hardware cost, a one-time software cost, vendor project cost, and internal project cost. And to add to all of these, there's a bottom line ROI that gets impacted by recurring annual expenditure, which includes maintenance fee, subscription fee, upgrade cost, update cost, and asset depreciation. So even for small changes, the IT is extensively dependent, or the AR team is extensively dependent on the IT team. And needless to say, for all different industries, IT is the one which has a lot of projects in their plate. So the minor changes also takes quite a lot of time to get implemented. And the operating expenses associated with deployment, operation, support, customization, or integration and maintenance are quite significant. The good news is on-premise solution is not the road for automation. On top of on-premise solution, the advantages that a cloud solution has are it is easy to use and it provides great benefit. Some of the benefits of cloud solutions is, first of all, the capex saving is significant. There's no upfront fee that you have to pay. There's an improved OPEX efficiency gain, annual recurring saving, and there's an ROI gain here. There's greater control and real-time visibility. And the cloud solutions are much more easy to deploy, and you can have a solution up and running in less than 3 months. Moving on. So for capital expenditure of an on-premise solution, you need to calculate the upfront hardware and server cost for hosting things internally, plus the software license that you might need to get the solution up and running in your system. And to add to this, the implementation fee, consulting fee, internal IT cost, and business cost. This is just an estimate, but this itself could have the cost roughly close to $150,000. When you compare this with the CapEx expenditure for a SaaS-based solution, you have a better efficiency gain. And the biggest difference is from an on-premise solution is the lack of an upfront hardware cost and the server cost for hosting all of these information internally. And you won't need to purchase software license for other systems to run through the cloud-based solution. And additionally, IT costs are reduced because most of the setup and implementation work is done by a vendor with a minimal IT involvement. Now, let us talk about the ROI and annual recurring saving here. So for an on-premise solution, the IT maintenance and software maintenance cost may rise based on variables such as increase in volume of data processed, increase in load, high frequency of upgrades and updates, and regular requirement of fix and patches. But for a cloud-based, SaaS-based solution, maintenance and solution fees are incorporated in the subscription price and are immune to business technology changes. So the depreciation cost would not be applicable for a cloud-based solution. Moreover, the cloud solutions are easy to deploy and it can be up and running in less than 3 months, some of them even lower. And with real-time data and scalable process, there is a significant positive impact on the AR operation control and visibility into the performance. So to burst the bubble, we can safely say that on-premise systems are not the end of the world, and cloud solutions, which are easy to deploy, need no upfront fee and not only provides automation, but also improved scalability of the AR process. So these are all of these myths. This is a high-level summary of the different myths that we have in place and what are the different ways in which these myths have been busted. So again, this is a very high-level summary here. Finally, we would provide you with the cheat sheet for the cash application. So here's the ultimate cheat sheet. As you can see, we have discussed most of these points today, like reducing the lockbox expenses. You can use automation and RDC in place. In terms of automating the e-payments like EFTs and wires, you can still use a cash application solution. Improved invoice level hit rate and positive impact on all the downstream processes. All right. So that's all we have for today.
Okay, thank you very much for your fantastic presentation and your insights. It's amazing to me how far along things in terms of cash application have changed in just the last, 2 or 3 years, but definitely a world of difference since I was a Treasury practitioner. So we're going to go ahead and officially open our Q&A session. Just a reminder, we can still take your questions in the questions area of your GoToWebinar control panel. First question, Raj, is a question that I had as well. Lockbox was kind of a sore spot for me. And can you give us a little bit more color on if there's scope to cut the Lockbox costs drastically, and really what are those drivers?
Sure. So, well, a cost analysis of Lockbox fee for a typical small and medium business indicates that a company could end up spending almost $50,000 annually based on surveys by CRF. And even after paying a huge sum to the bank for the Lockbox service, which is $1 or $3 per check, the payment processing is still not 100% straight through processing. And 80% of the time, the Lockbox has to first reconfigure manually before any value can be extracted from it, which is again time-taking and error-prone process. And you would also have to manually reconcile the information, and this additional work translates to an increased manual effort invested by your team, adding to the cost. So in a nutshell, yes, there's a drastic scope of reducing the Lockbox cost, and Lockbox is a very expensive and an impractical solution.
Okay, fantastic. Thank you very much. Maybe a couple questions around this area. I'll kind of put these together. Can you give us a sense of the size of company where the economics make sense here? Does it make sense for a middle market company? And then are there any specific industries where you're seeing more adoption?
All right. So I think based on my experience, again, this could be across the different sectors or across the different industrial sectors that I have interacted with. There's no particular sector where we have seen these kind of adoptions, but it could be across the different sectors that we have in place.
Okay, fantastic. Can you expand a little bit on the benefits of you talked about one way to go is to go with remote deposit capture. If companies go this way, do they have to rent machines, or how does that work?
Yes, and great question. So there are 5 different points here that you should ideally consider. First is the straight-through processing. So remote desktop capture or RDC, the solution itself is capable of capturing check payments and remittances accurately and handling exceptions with a hit rate of more than 95%. Second part to it is cost effectiveness. So what we have in place today, we call it RDC 2.0. It is on top of what typically you see in RDC. And RDC 2.0 it's involved in high cost saving. So the areas where RDC can cut cost are, so first of all, an RDC scanner is a one-time investment and it's very cheap to procure. So it can also be available at a monthly subscription instead of an upfront payment. The second part is the expensive lockbox services. So this could generate close to 5-digit dollar saving, and the cost required for resources are just for keying in the data. To add on to these, there is transportation and manual handling cost. So again, this comes to cost effectiveness. The other aspects of it is compatibility. Since RDC 2.0 solution rely on integration of regular RDC scanners with artificial intelligence enabled cache application solution, they are inherently compatible with most popular RDC scanner available in the market, including probably the one in your desk. And the bank and ERP agnostic part, again, the solution is independent of the type of bank or ERP the supplier uses, and this enables business scaling in terms of operation and geography. And last but not the least, real-time cache application. So the moment the check hits your company, they get scanned, processed, and posted in your ERP.
Okay, great, fantastic. As we saw in the polling question, one of the biggest challenges was multiple formats on remittance. Can you give us a sense of how flexible the solution can be in processing information received in different formats? And then again, just maybe review for us what are the different formats that can be supported?
Yes, got it. So as of today, we understand the ability to receive remittance data in different format. And this is important to any organization that we interact with and companies that have no control over what format the customer is sending you the information. So we have done our research, and what we truly believe is it is rather easy to have a technology in place than to change the customer behavior, which could be very time taking and it could be a very painful process. So this is the reason our solution has been designed to accept remittance information from all possible sources like EDIs. So when I talk about EDIs, it could even be different formats of EDI, an EDI 820 or an 823, from bodies of emails, from email attachment. And when I talk about email attachment, it could be an Excel, text file, doc file, PDF, CSV, all of those. Through XMLs and websites, which makes it customer friendly for the system to do business in. So the solution is really flexible around the formats.
Raj, final question for you. Can you let us know what's next in terms of the functionality for cache application, and also let us know how AI is impacting other areas of AR in terms of collections and DSO? All right, I'm going to go ahead and close our polling question here. And we are going to go ahead and formally close that polling question, and we will get Raj's comment on that question in a post blog that I'm going to write about that, and we'll let you know what's coming next down the pipe in terms of the functionality of AI in terms of cache application and in collections and DSO. I once again like to thank Raj for his great insights today. Thank you very much. And thank you, Raj. And
You're welcome.
I'd like to thank our webinar partner, HighRadius. We appreciate their commitment to thought leadership, which is also evident in the great content and resources they offer, which you can review on the HighRadius website. Also want to let you know that you'll have the opportunity to request to be connected with Raj via a few mouse clicks in the post-webinar survey. We have several questions, so it'll be a great opportunity for you to connect directly with Raj. And finally, to you, our audience, thank you very much for your valuable time today. Please let us know what we can do better and make the rest of your day great, everyone.